What will you glean? And I know what you're going to tell me. You're not going to rely on one data point. But what does the data point of January 12, the inflation report, signal to the Fed, where possibly they will have 3 data points lined up marking some form of disinflation?
Powell has been very clear that to achieve success, he needs to see moderation of goods prices, which he is seeing, moderation of services prices, excluding housing, which he's not seeing, and more slack in the labor market, which he's not seeing. So he's only achieved 1 out of his 3 goals. So the thing to focus on is what's happening to services inflation, excluding housing, because we know housing is going to come down with a lag, and what's happening in the labor market. We have, the last payroll employment increase was 261,000. We need to see payroll gains of, 50,000, 75,000 a month. We need to see an increase in the unemployment rate, unfortunately, to generate kind of slack in the labor market we need to get inflation down in the services sector.
You were expert on this at Goldman Sachs with a guy named McKelvey and a young Turk named Hatzius. And the bottom line, I love, Bill, what you're saying. We need to get from 200,000 plus down to something that's the run rate of 50, 75,000 non-farm payrolls. When we do that, where does that dearth of job growth come from? I mean, there's no evidence out there on how to get from here to there, the main phrase. I'm trying to talk like I'm at Bowdoin, but I'm going down in flames. How do we get from here to there?
Well, what the Fed has said that we need tighter financial conditions. We need tighter financial conditions to slow the economy down so there's less demand for labor. That's why Powell in his press conference last week was basically pointing out if financial conditions ease, then the Federal Reserve is going to have to do more. The Fed is targeting financial conditions because that's the mechanism that slows down the economy. When bonds rally and stocks rally, then that just means there's more for the Fed to do.
Bill, I've been confused by the market response after we got the latest Fed meeting. There hasn't been a real increase in bond yields, and there is still priced into the market a lower terminal rate than what the Fed is saying that they are going to do. How do you understand that?
Well, there's 2 possible explanations. Number one, the market thinks that the Fed will blink once the unemployment rate starts going up. So the market is basically saying that the Fed doesn't mean what it says. They're saying this to try to talk tough, but when the going gets difficult, the Fed will fold. That's one possible explanation. I don't believe that. I think Powell's going to do what he says. And number 2, they may just have a more benign view about how fast inflation is going to come down. I think the market is overweighting the improvement in goods price inflation. We knew goods price inflation was going to come down for 2 reasons. Number one, the switch in the pandemic has reduced the demand for goods versus services. And 2, we knew that some of these supply chain disruptions were going to normalize. The fact that used car prices are falling now is no surprise to anybody.
At the same time, people point to the fact that credit card receivables are going up. People are borrowing more. It indicates the cushion is getting used up. And there will be a music stoppage at the beginning of the year, that people will stop spending, and perhaps they already are. How do you push back against that and say, no, there is actually more momentum, more dynamism behind that this Fed has to curb?
Well, one aspect of goods price inflation going down is the overall inflation rate's lower, so people's wages go a bit further than they were before. And as you said, the excess savings is coming down, but there's still about $1.5 trillion money of savings above what you would expect the situation to be if we hadn't had those large fiscal transfers. And finally, there's going to be a lot more income for people caused by indexing. So look at Social Security, 8.7% increase coming next month. That's a $100 billion increase in federal spending. All those people are going to go out and spend that money.
What kind of recession do you foresee, given the outlook that you're talking about, given the fact that if gasoline prices rise, you end up with another situation at a time when suddenly the momentum is waning?
Well, I don't expect a recession quite yet. I think the economy still has considerable forward momentum. If you look at the Atlanta Fed GDP Now forecast for the fourth quarter, it's in the 2 to 3% range. And I think that the economy will continue to grow through the first quarter. I think the recession, when it finally does occur, will be mild because the Federal Reserve is in control. This is a recession, if it occurs, is completely induced by the Fed to generate more slack in the labor market. That means once enough slack in the labor market has been produced to bring inflation down, the Fed can relent. Short-term interest rates are going to be around 500 basis points, so plenty of room for the Fed to cut rates to stimulate the economy when the time comes. This is one reason why I think the stock market is still pretty buoyant, given the fact that a recession is likely, because they see the other side.
Bill, this is why we love to have you on. I mean, the idea, and this is so important, folks. I knew that we were going up 8.7% in Social Security, but there it is, Dr. Dudley quantifying it and showing that it's a return. Bill, it's almost like, I expect Wayne Angel to be on after you. We're almost like back to the 60s and 70s with an observation like that. Is this good old demand pull inflation? I mean, is that where we are? We got our Social Security check. Let's go spend it, and prices go up.
Well, nominal GDP is on a strong trajectory, and the Fed needs to take that nominal GDP growth, which has been running around 9% over the last year, down to about 3%. That's a big job for the Fed to pull off.